I ran every Mag7 company through a single test. 3 passed, 4 didn't. And the company at the top of the list isn't who you think it is. Almost every Mag7 company just reported earnings. I went line by line through every transcript looking for one thing. For every dollar of AI infrastructure spending, what actually came back? The answer separates this group in a way most coverage is missing. I'll get to the full ranking in a minute. But first, one company's AI cloud division just doubled its operating margin in 12 months. Not its revenue, its margin. That's the signal I'm building to. I'm not a financial advisor. Numbers are as of filming. The combined Mag7 is on pace to spend close to $1 trillion on AI infrastructure over the next 18 months. And the gap between who is converting that spend into real, measurable returns right now and who is burning cash on promises, that gap is wider than it has ever been. That's the CapEx Payback Test. 3 signals. Is revenue growing faster than capital spending? Are margins expanding, not just revenue? And is there a locked-in backlog, signed multi-year contracts, proving customers are committing years out, not just this quarter? Run every Mag7 company through those 3 questions. You get a completely different picture than the headlines give you. Starting at the bottom, Tesla, revenue $22 billion this quarter. Capital expenditure guide for the full year, over $20 billion. With management flagging a step up in AI and autonomy-related investment. More spending than a single quarter of revenue going back into the machine. Free cash flow? Musk said it himself, negative for the rest of the year. The automotive margin improvement looks solid at 19.2% until you read the fine print. One-time accounting items got it there. Energy storage margins hit a record 39.5%. Same fine print, different line item. Strip them out, the results are ordinary. Tesla's real thesis is Optimus Robotaxi, the cybercab. Musk said robotaxi revenue won't be material this year. Optimus production starts later this summer, and he said expected to be quite slow at first. Every genuinely exciting thing is 12 to 24 months away from converting. Apple, revenue $111 billion, up 17%. iPhone grew 22%, gross margin at 49.3%. Legitimately strong numbers, but Apple doesn't really take the CapEx payback test because they're playing a different game. Their AI is on device. Apple Intelligence runs on Apple silicone inside your phone and your Mac. They're not selling cloud compute. They're buying AI chips from TSMC, not renting infrastructure capacity to customers. And Tim Cook said something on this call that matters. Memory cost will have an increasing impact beyond June, growing from there. Every company here is dealing with memory inflation. The cloud infrastructure companies generate AI compute revenue to help offset it. Apple absorbs the cost with no corresponding revenue stream on the other side. Remarkable business. Different lane entirely. Apple is the hedge in this group. Meta, revenue $56 billion, up 33%. Operating margin 41%. Those look like the strongest numbers in the entire group. But here's what the test catches. Meta raised its full-year capital expenditure guidance from $120 billion to as high as $145 billion. The reason? Component pricing, memory cost inflation. That is a cost-driven raise, not an opportunity-driven one. And Meta's AI products, the business AI agents racking up 10 million weekly conversations, are currently free. No monetization roadmap, no timeline. The user base is 3.5 billion people touching a Meta product every day. That moat is real, but they are spending billions building products they're not charging for yet. While Reality Labs pulled a $402 million in revenue and declined year over year. Meta will spend more before it earns more on AI. Gets worse before it gets better. So those 3 are out, but the next one barely makes the list. Microsoft. Microsoft deserves more than a passing mention. Azure grew 40%, stripping out currency effects. And AI annual recurring revenue, meaning what customers commit to spending each year, hit $37 billion, up 123% year over year. paid co-pilot seats crossed 20 million, up 250%. The commercial contract backlog hit $627 billion, roughly doubled year over year, including the restructured OpenAI relationship. Those numbers are real, but Microsoft's CapEx to revenue ratio is the highest of the hyperscalers. Gross margin slipped year over year as infrastructure costs build, and Azure is currently supply constrained. Management saying demand is outrunning the ability to serve it. That's not permanent, but it delays the proof. Microsoft is the honorable mention. Strong signal, but not the cleanest payback yet. Now, the three that passed. And number three, you can argue it without a single line from his own earnings call. NVIDIA hasn't reported yet. I don't need their numbers. Every company on this list just told me exactly what they're spending on NVIDIA hardware. Microsoft called it out, Google called it out, Amazon called it out, Meta called it out. When every major customer you have is reporting record capital spending and your name is in every transcript, your own earnings call is almost a formality. The demand signal is already in everyone else's numbers. NVIDIA is number three, but the caveat is real. The market has already absorbed that evidence. The expectations heading into their report are high. The gap between what they show and what's already priced in, that's the watch signal going into earnings, not the ranking signal. Amazon surprised me. It should surprise you too. Most people still process this as a retailer with a cloud business attached. AWS posted $37.6 billion in quarterly revenue, growing 28%, the fastest pace in 15 quarters. Operating income from AWS alone hit $14.2 billion. Total company operating margin, 13.1%, the highest in Amazon's history. The committed future backlog, $364 billion in AWS contracts, plus a very large multi-year commitment from Anthropic, the company behind Claude. Now, here's the part most people skipped entirely. Amazon built its own AI chip called Trainium. On this call, management made the case that Trainium materially lowers their AI infrastructure cost base, a structural advantage that shows up in the company's overall numbers, and gives AWS a meaningful operating margin advantage over running on third-party hardware. Let that land. They built the tool that makes building the infrastructure cheaper. That is a self-liquidating loop. Spending that reduces future spending. No other company in this group has that structure. Lowest capital expenditure ratio of the hyperscalers. Highest operating margin in company history. Amazon is number two, which brings us back to where this started. One AI cloud division, 12 months, operating margin, 17.8% to 32.9%. That is not a rounding error. That is proof. Google Cloud crossed $20 billion in quarterly revenue, up 63% year over year. The backlog of signed future contracts nearly doubled to $462 billion. That number matters more than the quarterly revenue figure. Customers aren't buying Google Cloud for this quarter. They're locking in spend years into the future. Management cited 16 billion AI tokens processed per minute on this call. The utilization data backs everything the backlog is promising. Google is also now selling TPU hardware directly to external customers, their custom AI chips, a revenue stream that didn't exist 12 months ago. Full-year capital expenditure guidance is $180 to $190 billion. Significant, but when your cloud division nearly doubles its operating margin in a single year, the payback question is answered. The capital is working. Google is number one, and that is why the Mag7 basket trade is over. Owning all seven isn't a strategy anymore. It's an index. 3 companies have demonstrated real, measurable payback on their AI spending, margin expansion, locked-in backlog, cost structures that compound. 4 others have varying degrees of promise, deferred revenue, and timelines that need another 12 months to prove out. The market sees 7 AI companies. You see 3 that have proven the math works. My newsletter isn't a stock breakdown. It's how I use first principles to spot the structural shifts moving markets and the companies positioned to benefit. If that's the lens you want, links in the description. Now subscribe for more.